Hey everyone, today we're sitting down with Bryce Bettencourt from Chartered Finance. And trust me, this is a must watch if you're looking to navigate the mortgage maze in today's fast changing market. Bryce is here to break down the essentials, share insider tips, and help you stay ahead in a landscape that's shifting day by day. So if you're serious about understanding your mortgage options, grab a coffee, hit that like button, and let's dive in. What are you seeing right now? Like what's going on? What's really
Yeah, I
going on
mean,
when it comes to people getting mortgages today?
the main things that I'm seeing, the questions that we were getting, let's say, I want to say almost 10 months ago, as opposed to now, was, are we doing variable? Are we doing fixed? So a lot of conversations now with people getting mortgages are trying to keyhole on the absolute best deal. Like, where am I going to save the most money? We don't know. We don't definitively know, but the one thing that we do know is that with a fixed rate, where they were 10 months ago, even where they are now, is not a bad option. It's an affordable option right away, but with Bank of Canada as of today, last week dropping the rates by zero point 0.5 on the Bank of Canada overnight rate, and projections of December being another potential 50 or at least a quarter, and then going into next year seeing the overnight rate drop by potentially 1.5 to 1.75 potentially. The conversations are now, should I take a variable, right? And to be honest with you, and I think you and I discussed this previous as well, what I'm telling all my clients is you can't, let's get rid of the rates. Take the rates out of the picture. I'm going to give you two payments. One payment's going to be lower. That's going to be the 3-year fixed rate. They don't know it's a 3-year fixed rate, but one payment will be lower. The other payment will be slightly higher, but there's a potential for that to drop. So if the slightly higher payment I give my clients is putting them in a position where, hey, that's actually not that bad, I can afford that comfortably without changing my lifestyle, then I'm gearing them towards the variable. And that's when I tell them that's the variable rate. And the reason why I do it that way is because the last thing I want for any particular client is to put themselves in a position where, for a short term, from now to let's say next June, where the payment is not manageable, because it doesn't make sense. You're going to stress
Mhm.
yourself out for 6 months where you were, for a lot of people refinancing at least, have been stressed because of the increased rates. And the rate doesn't matter. It's your lifestyle, right? So,
Right.
I'm not going to put you in a position where you're going to continue to be stressed when that lower payment, you turn to me and say, hey, that's really affordable for me. And that's the case. That's what we're going to go with, because ultimately peace of mind and sanity, even when it comes to mortgage payments, it's got to make sense. So, a lot of my clients even now, and this, like we discussed yesterday, are having conversations where, does it make sense to break my mortgage then? Like with rates going downwards, should I break my mortgage and lock into something that's going to be lower so I can reap the benefit later? The one thing that I've been dealing with when I have clients that do that, courtesy call. Call your bank, ask what the penalty is.
Right.
And for example, I'm dealing with a situation right now where a client last December purchased their first home,
Okay.
3-year fixed rates at the time, 6.4.
Okay. So
So
their
her
mortgage rate is 6.4
6.4 right
on their
now,
new home. Okay.
1 year in on
Yeah.
a 3-year term. So 2 years
Okay.
remaining.
Right.
Where I'm seeing fixed rates right now or variable rates right now, we could be anywhere around 4.19 to 4.39 on a 3-year fixed, and let's say 5.05 to 5.15 on a variable. So the client gave their lender a courtesy call, asked, hey, if I broke today, what would my penalty be?
Sure.
Penalty came back at $8,200. Okay. Some
Mhm.
may think, okay, $8,200, that's, it's not cheap. It's a pretty penny.
Yeah. Yeah. It's a good
But
chunk.
and all I do with that is say, okay, at the end of the day, numbers are numbers. It's going to be black and white. There's not going to be a middle. So right now on her existing rate, she is making payments at 3280. Okay. Let's take her balance at 525. Let's increase it by $10,000. Okay. Because that would be the cost of the penalty,
I was going to ask
8,200.
you, who's going to pay for that penalty? Is that
We're going
cash
to
or
roll
it's
it into the mortgage.
cash
There's
coming out in this scenario for
no
the client's pocket?
exactly.
Right.
And under this scenario with this specific client, we're doing a small debt consolidation, 10K.
Okay.
Okay. So something very small, insignificant to the bigger picture. But I want to use it because it makes the example even sweeter.
Okay.
So the total new mortgage amount that I'm applying for them is 550,000. So we're going from 525
Right.
to 550.
Okay.
525, your payment is 3280 at a 6.4 rate. If we are able to obtain a 4.19 rate on a 3-year fixed on 550, your new payment would be 2675. Okay. So this is where the math, it's just black and white.
Right.
We take 3280, we minus it by 2675. That is a payment difference of $605 a month.
And that's real cash, right? That's real cash coming out of that person's pocket every
Correct.
month.
That's
Right.
their monthly payment is decreasing by $605.
Okay.
We're going to multiply that by the term remaining, in this case, 24 months. That payment difference is now 14,520.
Right.
The penalty is $8,200.
Right.
So not only are they reducing their credit card debt by 10, 15K, not only are they rolling in their penalty of 8,200, they're reducing their monthly payments by 600. And even if just for the next 2 years, the rates go down further, are already going to be ahead of the curve by, sorry, my phone locked, minus 8,200, $6,300 total between the
Right.
savings and the penalty. So in a
Right.
case like this, 100% it makes sense to break the mortgage. You're not extending the amortization by 15 years in this strategy. You've only owned the property for 1 year. So pushing that back out one extra year, adding an additional year to your mortgage, but reducing your payments by $600 in this specific situation makes perfect sense.
Right.
And what I've been telling all my clients that are in these situations that bought something in late 2022 or early 2023 is just call your bank, ask the question. And this goes for variable rate clients too, because in 2023, the variable rates were probably around prime minus 45, prime minus 40, where we're seeing variable rates discounted at prime minus 90 to prime minus 80.
Sure.
So let's say for a client who wants to keep a variable rate, but their variable rate before is prime minus 45. Yes, it's also decreasing. So when we calculate this math, there's a few different moving parts that we actually have to get to. But the point blank and period will be if you bought in 2022 to 2023, you may have 3 years remaining on your term at prime minus 45. So even if we bottom out, your rate could be 4.5%. If we readjust that to what the in-market variable rates are in exchange for a penalty that could be $5,000, we could be bottoming out at 3.5%. So there's a significant swing between the two variable rates for even those type of clients. So literally anybody that's been refinancing or that's looking to refinance, switch, renew, purchase, get a new property upgrade, call your banks, find out the penalty, talk to a broker. Let us tell you the black and white, the math. Does it make sense for you to break now to lock into a better situation further, right? And don't be wrong, it's a double-edged sword. Could you hold out for an additional 2 years of your term, save $8,200, right? But take advantage of potentially a lower rate in 2 more years? Sure, but I have some more math for you. That same client we discussed earlier that could be saving $605 a month, the bank said to her, we have a product called blend and extend. That's where they take their existing rate, they blend it with the in-market rate. It saves you the penalty. It extends your term the exact extra year that we are doing now.
Right.
They came back with a 3-year fixed rate blended at 4.51%, which equates to a payment of $26.90 a month. So let's use that as an example. $26.90 minus $26.75. We're talking $15. However, this would not be rolling in the credit card debt of the 10K, and it keeps your payments the same. So if you're taking that payment of the credit card, which is 15 grand, your minimum payment's probably close to a couple $100 a month.
Sure.
By being able to roll that in, even with that penalty, yes, you are increasing your mortgage, but in exchange for that, you're technically getting 3 more years at a lower interest rate. So overhead wise might be marginal,
Right.
but the amount of money that's being applied to principal would be significantly more. So in a situation like that, again, the blend and extend could be an option. And with the specific client, I told her, ask what the blend and extend looks like along with that. Because again, at the end of the day, it's just math. 4.19 or 4.51, right?
Right.
And the math ends up doing itself a service from there. And
So
we're obviously increasing our mortgage.
The banks obviously understand that it makes financial sense for people to break. So they'd rather keep the client, giving them this blend and extend. Now, that's not a refinance. They're not getting that extra 15K. Like if you're paying credit card at 19, 20%, whatever the credit card rate is on 15K, 20% on 15K, what is that? $3,000 a year. But if your rate is, 4.5 or 4% range, versus 20% on that 15K, which is what it would be. So there's extra cash savings there. So
Yeah.
yeah, I guess also every client, every homeowner should, property owner should contact their bank. They should contact someone like yourself to run these numbers and see what they actually shake out, what the best option is. But there is an
100%.
opportunity here regardless, because
Oh yeah.
we're going from high rates, like the Bank of Canada has dropped rates 4 consecutive announcements for a total of, what is it now, 1.25?
So we
Yeah.
were at, yeah, 1.25. Yep.
And then what's kind of your sense? I mean, there's every economist has got a different idea of what's coming in December, what's coming in the new
Yeah.
year. What's your pulse on that? And not going to hold it to you because no one really knows what's going to
Yeah.
happen
No,
tomorrow. But what are
and
you
I love these
seeing?
questions. I
Yeah.
honestly, I think the Fed just came out as either this morning or yesterday. I can't remember exactly when I read it, but said they're pretty much a slam dunk for a quarter basis point. Now, the Fed at their last meeting dropped by zero point 0.5. We typically follow the Fed. So when the Fed dropped by their zero point 0.5, our projections in September all changed. It went
Right.
from 0.25 in October and zero point 0.5 in December to now zero point 0.5 in October, which ended up happening. So if we're following that same trend, even though Canada likes to follow what the US does, it's not a foregone conclusion by any means. So I think we're still too high. So my personal opinion is that I would like to see a zero point 0.5 drop in December. That way, into going into 2025, you can slow down the decreases.
Sure.
Whereas, if you do a quarter, which I think a quarter is a slam dunk, but I think zero point 0.5 is not off the table. In 2025, if you only do the quarter in December, you may be more inclined to continue to drop at a faster pace going into summer of 2025. So personally, I'm seeing zero point 0.5 in December. I'm seeing possibly another quarter into January. And then depending on how that all starts to look, a little bit of a slowdown, but ultimately getting to their bottom line into July and June of next year.
And what is their terminal rate, their bottom line? Like, what are they trying to get
So
to?
yeah, so those projections are what they're saying. Again, earlier this year, they said
Mhm.
that the projections were 2.5 to 3% as their
Right.
bottom line. Right now, like you said, we're at 3.75. I think it was 2 months ago, they changed their tone and said that it might be 2% to 2.5%,
Right.
which still puts us at, like we said, I think it was 1.25 to 1.75 to go.
Right.
And me and you talked about it yesterday. It's still crazy to talk about, but you take us back to 2019, 2020, when the
Mhm.
overnight rate was around 2%, rates were around three, we're in this 3% range. And when they went down and people were getting 1% mortgages, everything was great. But then when it started to increase back up to 2% or 2.5%, it was panic. You know what I mean?
Right.
Like everybody was how can we afford this? And fast forward 18 months, here we are, and all we're doing is begging for it to get back down there because now that becomes affordable. You know what I mean? So
Yeah.
putting all those things on the table, it's funny to talk about. It will change the housing costs and affordability, which I know you can probably speak more to, but I would start to see a little bit of an uptick in housing prices just because you're going to put a whole pool of buyers back in when they were holding out for this specifically. You know what I mean? So there's a
For
lot of
sure.
pent up buyers, in my opinion, that are waiting for this opportunity. And unfortunately for some of the sellers, they may not be able to sustain to that timeline, right? Where they have to liquidate early. And I'm dealing with a few of them right now where we're trying to buy clients time by refinancing because affordability is still tough for a lot of people out there. You know what I mean? Which is why my projection's at 0.5 because it is still tough.
So let's talk about that actually, so we're talking about people buying, or who have just bought. So now we're talking about, people who might need to sell. And what do you mean by buying? It's tough, but what do you mean by buying time? What kind of, in
Sure.
general, what kind of situations are these sellers facing and
Yeah.
why refinance?
Yeah. So let's say, for example, somebody got tied up in a variable rate or somebody got tied up in a higher fixed rate because of their renewal timelines, whatever have
Sure.
we don't have to get specifics into loan sizes. That's irrelevant in
Right.
the picture. But if there's equity in the property, okay, so let's say it's worth 1 million, your loan's at 500, we're at 50%. The payments are, let's call it 5 grand a month,
Sure.
6 grand, 60 grand a year to sustain those payments. Some professionals, realtors, could say that if you can hold out 1 year, if we sell next year, you'll make more money.
I see.
The question I bring those clients are, will you make more than 60 grand? If the answer is yes, then we can look at the potential of refinancing that first mortgage or getting a short-term secondary financing to allow them the financial flexibility to make that 1 year's worth of payments to then ultimately sell their property for maybe 100,000 more,
Right.
right? So it's one of those things where this shoe does not fit for everybody. If you're in a market well outside the GTA where it really did boom, but then now it's come down significantly, it may be a situation where you have to kind of cut ties or, cut bait, making a payment, and I have a client right now, a similar situation where they have to make 5 grand payments on a property that's not going to increase by 60 grand a year.
Right.
So, doing anything secondary or doing anything that might buy them time is not buying them time. They're just digging their hole deeper, and the asset becomes a significant liability where, you're where you would have lost only 100 grand if you liquidated. Now you're set to lose 160 if you try to keep it for an extra year because it's not going to go up by the 60K, right?
Right.
And to
So
that
the
point,
issue here is like these cases are maybe people had rates, that they had to renew. So they were paying, what would they have been like if in this example, just ballpark. So if they're paying
yeah,
5 grand now a month, 60 grand a year, what were they used to paying before that, roughly?
yeah. So let's say somebody got into 1.79,
Right.
right? Back, 2019,
2021.
2020.
Okay. Yeah.
Let's use that 550K number. We're
Okay.
talking a payment at 179 would be 1975. So you're literally paying $700 swing between the
Sorry,
two rates. If you had
1975 a month.
1975 would be a 1.79 on 550K.
Yeah.
That's what you would have been paying 4 or 5 years ago. Now
Okay.
you're in a position where you have to renew, and now your payment's going up by $700.
Right. So
Some of those people, $700 may not be sustainable for them.
right. So they're basically have a cash flow crunch where they're in their home
Exactly.
and they don't have the cash to pay their mortgage. So they're trying to figure out how to pay it.
Yep.
Some people, if they think that they can refinance now, maybe borrow more money,
Yep.
but then they're basically speculating that their home value, they're gonna have to sell. Either they have to earn more
Yeah.
money or sell.
Yeah.
Sooner one
Yeah.
or the other. And so some people may want to roll the dice saying I'm in a market where yes, I think, I'm going to see, some kind of property price increase, rates will come
Sure.
down and I can sell. But then some people that's not going to happen. So then they
No.
are going to sell and take whatever loss there because they literally cannot afford to pay their mortgage.
Yeah. And like it's $700 is a lot of money. You know what I
Sure.
mean? And when we're talking back then, the qualifying rate for
Right.
these clients was 5.25.
Right.
Now we're talking about rates being higher than, I mean, thankfully they've come down, but
Right.
some of the rates for some of these people when they renewed were higher than 5.25. So affordability in that situation is completely out the door. So that's why all of this stuff is kind of I think they're fast tracking it because they
Mm.
know the timeline for a lot of these clients for renewals is now into early next year.
That's right.
Where if
Isn't
they
it the
don't,
majority of mortgages coming due in
yeah,
2025 of fixed rate mortgages in Canada?
COVID happened March 2022 in Canada when everything went crazy.
March
All the rates
2020. Yeah.
sorry, March 2020, sorry.
Yeah.
And the rates plummeted thereafter. I think
That's
probably
right.
the third week of March. 5 years from then is right, 6 months
see.
away. And you're
Yeah.
allowed to start doing things with your mortgage within 6 months with your existing bank
Okay.
or 120 days if we're trying to take it somewhere else.
Sure.
So that's why I'm thinking they're fast tracking a lot of this Bank of Canada rate
Right.
drops. But also for those people that qualified at the time at 525, theoretically, they now have to qualify for 2% higher, which is another reason why I'm not sure if you heard in the news a couple
They
months ago,
changed the switch rules, right? Tell
November
us about that.
21st.
Yeah.
Yeah, so November 21st, they're changing the switch rule. And what that is instead of if you're not intending on taking any money out,
Mhm.
you just want to transfer to a lending facility for the exact same dollar, you don't have to qualify at the stress test.
Right.
You just have to qualify at what the in-market rate is. And that is huge for buyers, for a
Right.
refinance, or for anybody who's shopping
Right.
their mortgage, right?
Yeah.
Because now we're talking about if the rate's 4.19, you only have to qualify at 5.25. You don't qualify for 6.19. You know what I mean?
So this will
Having this
allow
rule,
competitiveness, right? You don't have to be tied to your
exactly,
lender on your renewal. You can go to someone like a mortgage broker like yourself who shops with works with a variety of lenders.
exactly.
You say, okay, lender A is going to give you this rate, but and you're not penalized for switching. So, but again, this speaks to the fact that I think that they know how tough it is for people
Yeah.
who bought when rates were ultra low and now are renewing. Even as rates come down, they're still renewing at 2-3 times their 2020 rate, perhaps. Right?
100%. And
Yeah.
honestly, I think it's keeping lenders honest.
Yeah.
because some lenders, they know the situation that you're in,
Right.
and they may give you the first renewal offer that isn't competitive.
A lot of things are changing right now.
100%. And don't get me wrong, a lot of people have their own opinions on reasoning or what they think of that in the pool of. I don't necessarily agree with some of that stuff, because what you're doing is you're allowing people to potentially put themselves in worse
Yeah.
off positions.
Or more with
Um,
less skin in the game. But you
yeah,
still have to qualify it, right? But it's still,
exactly. Don't
yeah,
Yeah, and don't get me wrong, there's still that, but like I would lean this more on the side of, you know what, let's say you found a property at 1 million and you're in a bidding war, and it went up to 1.05, and all of a sudden now you need to come up with 200,000 as opposed to
sure,
100.
sure.
That's a big swing. Could CMHC said, you know what, we can make exceptions now slightly over 1 million?
Right.
Sure. But now when you put it all the way up to 1.5 and you're telling people they could put down 150K instead of 300,000,
So it's
up to
10%
10,
instead of
exactly 10%.
not
Because the math is
5%.
still the math. It's
Yeah.
5% of the first 500,000 and 10% of the
Oh,
difference.
okay. Okay.
So if we're doing 25K for the first 500 and 10% of the difference is 100,000. So 150 would be your minimum down payment.
Another thing is like a city like Toronto, right? Or Vancouver,
Yep.
where your average starter home, let's face it, is going to be well over $1 million
Yep.
for a home. Even some condos are averaging 800K to get in. But what if you're a few hours outside Toronto
Yep.
and your average starter home is not anywhere close to that? So it almost like it seems like they've applied a rule across Canada, and
Yeah.
that may actually maybe cause some, I don't know, a little bit of heat in some markets that
I
don't need it
agree.
because people can put down less now and pay
Yeah.
more.
And like I said, it's the fact that people have to pay an insurance premium on it anyway.
Right,
And if we're talking 3%, so you're putting 10% down on 1.5 potentially.
right,
You're only going to own 7% of that home from the beginning because the insurance premium is 3%
right. So that gets
around.
tacked on your mortgage, but
And that
it's
gets
still kind of like money you've got to put back in at some point. And there's interest on
exactly,
that 3%, right?
exactly. And the loan size is so high.
Yeah,
What happens if 2022 happens again, where there's a 20% decrease in value?
right.
You went from owning a property, pretty healthy price.
Mhm.
Those are the properties that drop
Right.
when the markets dip.
Sure.
It's not the ones in the 6 to 800K range. It's the ones that are
Right.
1.5. And if you
Right.
put down where you only own 7%, you might be in a position where you are stuck for a very long time paying a mortgage that could be very expensive
Yeah.
in exchange for the opportunity, you know what I mean, for a first
Yeah.
time home buyer to buy a
Right.
property. Like it's not necessarily a good thing, you know what I mean?
Yeah. And every situation is different, like if you can
Sure,
afford it
sure.
and you're going to be in
That's
that home
different.
for 10,
Yeah,
15
yeah,
years, right? But I think we've seen the risks of using really cheap money for the short
yeah,
term and then, the markets change. So definitely
yeah.
important to get your financing plans and options in order. I know we're wrapping up on our time, but any final kind of thoughts or points you want to get out to people?
Honestly, if I had to say anything, call a mortgage broker. That's the one thing. And like you said, just ask the question, hey, is there anything I can do that can give me an edge? A lot of people don't know that there's better options available. And we've had a discussion for half an hour. Our first discussion about just the payment difference between one rate and another was 3 minutes. I can see very quickly with a cancellation fee if it makes sense for you to try and pivot and do something better.
Right.
And don't get me wrong, in some situations, the answer is no, stay where you are. But in other situations, the answer is, hey, you can do something. I'm not the guy who's going to say, do it. I'm going to
Mhm.
give you the opportunity. That's a decision you need to make on your own. But if you are unaware of those options, very hard to navigate this rate game and this mortgage industry, because the banks want your money.
Yeah.
There is no loyalty in the banking game. You know what I mean?
Right.
It's who's giving me the money at the cheapest price, and that's the way you can have the exact same shoe without the brand name, this shoe with the brand name, but they're exactly the same.
Right.
Whose is cheaper?
Right.
That's how it should be, and a lot of people just don't know their options. So if there's one thing I can leave on is call a broker, talk to a broker, get referred to one, and let us help you with that, because that's part of our job.
Sure, absolutely. And where's the best way for people to get in contact with you? Should they go to what's the website?
Yeah, www.chartered-finance.com. You can email me directly, Bryce at chartered-finance.com. Instagram at chartered__finance. You can see us everywhere, and all of our contact information is all over the internet. So best way to
Amazing.
reach us is Google us, and we're there.
Yeah, Google Chartered Finance, you'll find you
Exactly.
everywhere. Awesome, man.
Exactly.
Look, let's do this again. Let's keep up to
Yeah,
date.
man.
There's a lot of changes happening right now.
For
We
sure. For
discussed,
sure.
and what's great is I think, people really want to hear these case studies.
Yeah.
What's really going on helps, at least for me, helps contextualize, some of the moving pieces.
Yeah, definitely. Well, it was a pleasure, man. Thanks for having me.
Thanks for making the time. Talk
All
soon.
right, buddy. Yeah, man.
Hey, I wanted to do this as a test, as a sample, to find out if this works for the green screen. If your guy is able to do something with this, put the Calgary condo investments behind it, whatever he needs to do. Does this work for the green screen? So this is a test. I don't know how long you need it to be for a test, but I wanted to be able to give you enough time, your developer, your video person, to be able to really tell, can you actually use this, a video like this, and be able to do what we need in terms of the stuff going on in the background with me speaking. Does this work? The lighting, I know it's not 100%. I can still play with that a little bit. It's a little bit bright on this side, but that is something that I can play with and fiddle. But before I started to do all that, I wanted to know, is it worth going forward? Is this green screen okay? Is this what we're looking to work with?